Hi everyone, I'm Ava, and welcome back to your financial journey. You've probably heard of index funds before. Whether you're at the start, middle, or even further along on your financial journey, they're one of the most popular and well-known tools when it comes to investing and building long-term wealth. But it's not always clear exactly what index funds are. So in today's video, we'll be covering index funds. Specifically, we'll be diving into what index funds are and what the key advantages and disadvantages of index funds are. And depending on your personal situation, if you really don't like the disadvantages that we'll be talking about today, then index funds may not be for you. For those of you who do like index funds and the advantages they offer though, I'll also talk about what some examples of index funds are towards the end of the video. Let's get started. What is an index fund? An index fund is a type of fund that tracks the performance of a specific market index. In other words, an index fund mirrors the performance of a larger group of investments. For example, the entire US stock or bond market, by buying a sample of each stock or bond within the market, usually in similar proportions to the market itself. The way it works is that fund managers try to match the whole market rather than choosing one specific company or asset to buy. For example, let's take the S&P 500, which is the 500 largest publicly traded companies in the US. It includes companies like Nvidia, Alphabet, or Apple, but also more traditional companies like Walmart, Coca-Cola, or Caterpillar. If a manager was investing money to try to make a profit, they could handpick individual stocks to buy, like just Microsoft or Meta, for example. If they pick well and those stocks continue growing, there's no problem. But there's also the risk that Microsoft and Meta will fall while the rest of the market keeps growing. So a solution to that is an index fund, in which the fund manager tries to replicate the index with a sample that's as close to the original as possible. The manager wouldn't try to pick the winners by buying only Microsoft and Meta, but also all other companies in the S&P 500, like Alphabet, Apple, Coca-Cola, Caterpillar, etc. The allocation within the fund would generally be in proportion to each company's weight within the S&P 500, so that more weight would be given to larger companies and less weight would be given to smaller companies. Essentially, investing in an index fund diversifies your holdings, or, as the old saying goes, prevents you from putting all your eggs in one basket. An index fund can also remove potential human error and emotion in favor of participating in the overall market's performance. Rather than being actively managed, in which a fund manager would choose individual stocks and when to buy and sell them, index funds are passively managed. There's very little buying and selling, other than when the index itself changes, in which case the fund is rebalanced to reflect that. And because the role of the fund manager in an index fund is relatively limited, that also means that the expense ratios, the fees that the fund managers charge, are generally very low, and you as the investor generally get the market's return minus a tiny fee. That's one of the great things about index funds. But there are more advantages and some drawbacks too, which takes us to the next part of today's video. What are the advantages and disadvantages of index funds? Like any investments, index funds have their pros and cons. And while many people use them, it's important to consider the different aspects of index funds yourself. On the positive side, here are 5 key advantages of index funds you should consider. 1. Diversification. Like I mentioned earlier, the point of index funds is to diversify your holdings so that growth in your portfolio isn't too reliant on any single stock. A single index fund can give you ownership of hundreds, sometimes even thousands, of companies at once, and depending on the type of index fund, it may also give you access to multiple industries as well. In that way, investing in index funds generally results in more consistent long-term results and more diversification than just a few specific types of stocks would. You don't have to worry about picking out the best company and constantly monitor your individual stocks, because the fund will do it for you. And that takes us to 2. Simplicity. Investing in index funds requires way less effort than actively managing a portfolio yourself, in which you choose specific stocks. Instead of constantly researching and monitoring stocks, you can focus your effort on budgeting, saving, and long-term financial planning. That simplicity can be invaluable when you have a lot of other things to worry about. 3. Transparency. Beyond making investing more straightforward and simple, index funds are also generally transparent and easy to understand. You can generally see the exact stocks you own every day on the fund manager's website and their proportions. and know that the funds will only reallocate in accordance with shifts in the market. Plus, they're generally easier to understand than more complex financial instruments, so you won't have to worry as much about where your money is going. 4. Long-term market growth potential. It's hard for professional fund managers to beat the market, or outperform it by picking individual stocks. For example, going back to our example of the S&P 500, according to Yahoo Finance, 90% of active U.S. large-cap managers had underperformed the S&P 500 index over the last 15 years. Outperforming the market is even harder if you're trying to manage your own portfolio on top of the rest of your life. And that's where index funds come in. Your actual returns depend on the index fund you buy. But continuing with our example of the S&P, the average return on an index fund tracking the S&P 500 has been around 10% per year for the last century, or around 7% after taking inflation into account. So by investing in an index fund, you can reliably capture the market's return. 5. Low costs. Because an index fund is passively managed, with its makeup only changing when the market itself changes, the expense ratios are far lower than for actively managed funds, as I already mentioned. According to Fidelity, index mutual funds expense ratios were 0.05% per year on average in 2025, a rate that's been declining for years. Compare that to actively managed portfolios, which, according to Investopedia, typically have expense ratios of 0.5% to 0.75%. That difference in costs adds up over time. For instance, let's assume we have a $100,000 portfolio growing at a 7% rate annually, after adjusting for inflation, and with monthly compounding. A 0.05% fee versus a 0.5% fee could mean a difference of thousands of dollars over the course of many years. And index funds can help you reduce those costs so that you can keep as much of your money as possible. After 20 years, with the 7% annual rate and monthly compounding that we assumed, the original $100,000 invested in an S&P 500 index fund would have grown to around $403,874. A 0.05% fee would add up to just slightly below $202, but a 0.5% fee would be around $2,019, costing you around $1,817 more. Those are the 5 key advantages of index funds, but there are some drawbacks too. Here are the 5 key disadvantages of index funds you should consider. 1. You have full exposure to market downturns and bubbles. The full market exposure in an index fund can be a positive thing if the market is growing. But if there's a market downturn, it means your portfolio will drop along with it without any action being taken on the part of the fund managers. Downturns are normal in any market, but if witnessing a market downturn or even a market crash without being able to reallocate your portfolio worries you, then index funds may not be the best option. 2. You can't beat the market. On the other hand, if the market is doing well, you'll be able to reap all the benefits, but you won't be able to do better than it. As I said before, beating the market is pretty difficult, but in certain scenarios, such as certain industries or special market environments, that may be possible. Investing in index funds, however, removes any possibility of that happening. By definition, your portfolio is only able to do as well as the universe of investments that the index fund is tracking. Plus, there's a small fee you'll have to pay, which isn't that significant but can reduce your overall returns. 3. You may have concentration within the index. While the idea behind index funds is diversification, it doesn't work perfectly all the time. Even some broad ones, like the S&P 500, can become heavily concentrated in a number of stocks. Those companies usually drive most of the index's returns, but that also means that the index can be less diversified than it seems on paper. For instance, according to this graph from JP Morgan in May, the top 10 companies in the S&P 500 made up 40.8% of the last 12 months' earnings. In this case, your portfolio will be more heavily dependent on a handful of names, and if any one of those companies do badly, the index will likely reflect that. This may be especially relevant for you if you fear a bubble, like the dot-com bubble in the 1990s, or possibly the current one with AI valuations. 4. There may be some potential tracking error. Tracking error, put simply, is the difference between the performance of an index and the performance of the universe of investments it's tracking. For instance, Let's say that in the past year, the S&P had a return of 9%, but the S&P index fund I invested in had a return of 8.5%. 0.5% would be the tracking error. Tracking error usually appears as a result of expense ratios, which are usually small in the case of passively managed index funds, but also from delays in rebalancing or funds holding on to cash. It might take some time for an index fund to match changes in a market, and the fund might hold on to extra cash in case of redemptions. This tracking error is usually very small, but it does exist, and over the course of 20 or 30 years, it might add up. So knowing that this disparity might exist is important if you plan on investing in an index fund. 5. There is limited customization. The idea of index funds is to simplify the investment process by choosing to emulate the market for you. But if you want to invest differently, you'll have a hard time doing that. There's different types of index funds for different assets or sectors, but within those index funds, you don't have that much choice. For example, you generally can't exclude specific companies or industries you don't want to own that are a part of the larger index. This may not be an issue, but if you have a strong personal preference to avoid a certain sector, for instance, index funds may not be the best option. Whether index funds are right for you will depend on your specific circumstances, as with anything else in finance. If you prefer to handpick your investments, dislike a certain sector, or just can't get over one or more of the disadvantages that we've covered here, you may have to look beyond index funds. That said, index funds tend to be good for long-term growth and diversification, and many people do own them. But of course, even then, you need to choose the right index fund to invest in. Which brings us to the next part of today's video. Examples of index funds. There are countless different index funds available today, with myriad markets tracked and assets covered. That means that index funds can also be differentiated in many different ways. But the main categorizations I'll focus on today are by asset, by market capitalization, and by geography. So first, by asset, meaning by the type of investments the fund makes. Index funds exist for stock markets, bond markets, real estate markets, and more. Of these, stock market and bond market index funds tend to be the most popular, and for many people looking for an easy way to invest, they can sometimes make up a major part of portfolios. Schwab's S&P 500 Index Fund, ticker symbol SWPPX, and Vanguard's S&P 500 ETF, ticker symbol VOO, are two examples of index funds that track the S&P 500 stock index. While Fidelity's U.S. Bond Index Fund, ticker symbol FXNAX, is an example of a bond index fund and tracks the Bloomberg U.S. Aggregate Bond Index. These different types of index funds can be good investments for specific goals, like growth for a stock-based fund or capital preservation for a bond-based fund in a stable interest rate environment. They can make sure you participate in any growth or safety of the universe of investments that you're tracking. The second way index funds can be differentiated is by market capitalization, or based on the size of companies they invest in. Market capitalization as an investment criterion is most often used for stock index funds, which can be categorized as large cap, mid cap, or small cap, depending on how large the companies included in the fund are. Broader funds, like the S&P 500 funds I just mentioned, would generally be considered large cap, with the most stability and predictability, while smaller cap funds might have high growth potential but be more risky. Mid-cap funds would be somewhere in the middle, and the type of fund you choose to invest in depends on your risk appetite and how much growth you want to see. And third, geography. This is relevant for most types of index funds, including stocks, bonds, and real estate. The main difference that comes to mind here is the distinction between domestic index funds, comprised solely of companies within the U.S., and international index funds, comprised solely of companies outside the U.S. The index funds I mentioned before, SWPPX and VOO for the S&P 500, and FXNAX for the bond market, are all considered domestic index funds. An example of an international index fund is Vanguard's Total International Stock ETF, ticker symbol VXUS, and some index funds may even choose to concentrate on a specific region, like Europe or Asia, or on developed versus developing markets. There are many additional ways of classifying index funds on top of these, and most index funds will fall into multiple categories. Plus, specialty index funds may be created for specific purposes, like earning dividends for income or focusing on a specific industry. At the end of the day, what matters is that you understand the index fund you invest in and choose the one that's right for you. What do you think? Do you own index funds in your portfolio? And if so, which ones? Or are you investing in other assets? Drop a comment below and let us know. Make sure to like and subscribe if you enjoyed this video. And check out this video here on how compound interest can make you rich if you invest regularly and have a long enough time horizon. Thanks for watching, and we'll see you again soon.